Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at XPO, or XPO Inc. XPO is a provider of asset-based, less-than-truckload transportation with proprietary technology that moves goods efficiently. Here's the barchart.com technical opinion rating for XPO. The bar chart rating is a 100% buy with a strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that XPO is well above the moving average line, so the monthly trend in XPO is up. Now we're going to look at a daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since last April, so for over a year. So the daily trend in XPO is up. Next, we're going to look at our daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. XPO is below the upper Keltner channel line, so XPO is inside the buy zone. Since the trend is up, we want to buy a call. XPO has 9 option chains to choose from. We're going to use the May 17 option chain. Right now, the May 17 options have 40 days to expiration. Here's most of the XPO option chain for May 17. XPO closed at 128.16 on Friday. That means any calls on the list from 80 to 125 are in the money. Let's take a look at the profit potential for purchasing the 130 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 130 call is 790 to 810. We tried to enter at the midpoint, so we'll use 8 even as the buy price. Our call option calculator shows the profit potential for this call based on XPO price changes at option expiration from flat to a 12.5% increase in price. We can see that if the XPO stock price is flat at 128.16 at option expiration, the 130 call will lose 100% of its value. Ouch. This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 115 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 115 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the XPO stock price is up 1%, the 115 call will lose 14.5% of its value. We want that to be break even or better, so the 115 call does not meet our requirements. Let's see if the 100 call will work. The bid-ask spread for the 100 call is 28.80 to 29.80. We tried to enter at the midpoint, so we'll use 29.30 as the buy price. The 100 call works. If the XPO stock price is up 1%, the 100 call will make a 0.5% or $14 profit. That's better than break even, so the 100 call is the one we'll buy. The call option purchase calculator also shows that if the XPO stock price increases by 2.5%, the 100 call will make a 7% or $206 profit. If the XPO stock price increases by 5%, the 100 call will make an 18% or $527 profit. If the XPO stock price increases by 7.5%, the 100 call will make a 28.9% or $847 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the XPO stock price does not make the expected move up and remains flat at expiration, the 100 call would only lose minus 3.9% or minus $114 compared to the minus 100% or minus $800 loss for the 130 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the XPO May 17 expiration 110 strike call and sell to open the May 17 120 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 110 call for $20.85 and sell the 120 call for $13.45. $20.85 minus $13.45 equals $7.40, 7.40. So the entry price or debit cost for the spread is $740. The call option spread analysis calculator picture shows that the spread will make a 35.1% or $260 profit if the XPO stock price declines by 5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $1,345 cash credit to our brokerage account for the sale of the 120 call. As we said on the previous slide, this reduces the cost of entering the spread to $740. Here's a note regarding earnings reports. The next XPO earnings report is scheduled for May 3rd. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the XPO May 17 expiration 100 strike call for $29.30. We also reviewed the spread. The spread said to buy to open the XPO May 17 expiration 110 strike call and sell to open the May 17 120 strike call at a debit of $740. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.